Warren Buffett is considered by many to be the greatest investor of all time, and each year following his annual Berkshire conference, there is a surge of examination that occurs, investigating every word he says during the conference. This year's attention was clearly centered around this, Berkshire's insane cash pile and what it could mean for the broader economy. To many people, these developments suggest that Warren is hinting at the fact that there is a massive economic crash coming to the United States, and this buildup is to prepare for it. One might naturally infer that when an investor hesitates to deploy their cash reserves, they perceive the market as lacking worthwhile opportunities. With Berkshire Hathaway's cash reserve ballooning to $189 billion, many speculate whether Warren Buffett sees the entire market as an overinflated bubble. With 500 companies listed in the S&P alone, the inability to identify sufficient suitable candidates raises eyebrows. The accompanying chart illustrates the unprecedented magnitude of this war chest. One plausible explanation often cited for this growth is the allure of current cash yields. When Warren Buffett mentions his $189 billion cash position, it's important to note that it's not actual cash, but rather cash equivalents in the form of short-term US Treasuries. This may sound confusing, but in essence, his holdings are generating a yield. The current 3-month US Treasury offers approximately 5.4% returns, which makes them a notably attractive guaranteed investment. However, Buffett himself clarified this misconception during this year's conference. He emphasized that even if the yield was as low as 1%, he would still maintain the same level of cash reserves. This belief is articulated by Buffett himself in the following clip. Take a listen.
This question's from Johan Halen, who writes, "You're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions are, 1, what is Buffett waiting for? And 2, why not at least deploy some of it?"
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%. Don't tell the Federal Reserve that.
So if he's not after the yield and he seriously sees no good way to spend the money, the natural assumption must be therefore that he believes that the current market is very overvalued. And of course, if it is overvalued, it must crash in order to become undervalued. Essentially, what a lot of people believe and extrapolate from these actions is that Warren Buffett is waiting for a crash, and while he's hesitant to admit to that, it's pretty clear that he expects headwinds. In 2001, Warren Buffett actually introduced his very own indicator to gauge the overall valuation of the US equity markets, now famously known as the Buffett indicator. This metric compares the US GDP to the total market capitalization of publicly traded companies in the US. Essentially, it looks at the nation's economic output against the collective value of its publicly traded enterprises. When either element deviates significantly from the other, it shows up clearly in the graph. Buffett himself called it probably the best single measure of where valuations stand at any given moment. Currently, the Buffett indicator stands at 199%, signaling that the US markets are significantly overvalued, nearly 2 standard deviations higher than historical norms. Historically, whenever this ratio has surged to such heights, the market has seen serious downturns. Unlike others in the finance world, Warren Buffett and Berkshire Hathaway don't try to predict recessions. They openly admit they have no idea when they will occur. However, we can distill their approach into a simple theory. They do a great job of recognizing when things are overvalued. Eventually, market forces will correct these imbalances, leading to opportunities. Warren understands that while he may not know when or where these corrections will happen, the current situation is abnormal and will likely change rapidly over time. Towards the end of the clip I just played, he shares something that really puts all of this into perspective. Take a listen.
You know, it isn't like I'm got a hunger strike or something like that going on. It's just that things aren't attractive, and there's certain ways that can change, and we'll see whether they do.
So what he said there at the end is, in certain ways they can change, and we will see if they do. Reading between the lines, we all know what this means. By practically every measure out there, stocks are severely overvalued, and you don't need to look at just the Buffett indicator to see that. For example, the 10-2 Treasury yield, an indicator that has predicted nearly every recession dating back 50 years, has now spent over 630 days being inverted, beating the record set back in 1978. When the 10-2 curve inverts, it's a classic sign that a recession might be on the way. This happens when short-term bonds pay out more than longer-term ones. It's like a warning signal that investors expect the economy to struggle in the short term, so they want higher returns quickly. On the flip side, they think things will get better in the long run, so they're willing to accept lower returns on long-term investments. Now, if you check the 10-2 chart, you'll notice it's still below zero, which means it's still inverted. Historically, this is a negative signal. However, it's not until this line climbs back above zero and stops being inverted that we usually see a recession. Right now, there are no clear signals that this will happen anytime soon, but considering we've just broken the record for the longest time spent in inversion, it's reasonable to think a recession might come sooner than later. Many Berkshire investors know that Warren will never be direct about bearish sentiment, as he knows just how hard it can be to accurately predict the timing of a recession, but most investors know that you can read between the lines of his statements and understand when he has bearish ideas about the market, and one of those times is right now. In fact, according to Bill Smead, Chief Investment Officer at Smead Capital Management, this is the most bearish Warren has ever been. Take a listen to this interview clip from CNBC where he provides his controversial analysis.
Fully in charge here. So let's talk about their big cash pile, $180-some billion, heading to $200 billion. What should they do with it? There is some discussion. Would you, as a shareholder, like to see them pay a dividend? Or would you like to see them make a big acquisition? Or would you like to see them buy back shares?
We have no interest in the dividend. It's fine to have them buy back shares, but you always have to think about Berkshire Hathaway, do as I do, not as I say. Because Warren Buffett is a super nice guy, and he has absolutely no interest in offending people. But if you look at what he's doing, he is as bearish as he ever gets. I read right between the lines, right from the beginning at the meeting on Saturday. I was there sitting in the audience, and I thought, okay, huge cash position, trimmed his Apple position. He's nibbling on something below the surface they haven't announced yet. But basically, he is waiting until the next 40% decline in the stock market to apply massive amounts of capital at bargain prices in things that are large enough to be meaningful to this company at the size it is now.
So you just used the phrase, this is as bearish, I believe you said, as I have ever seen him. Is that really the right characterization, or is it rather that he thinks the market is too highly priced for him to go in a big way and put fresh capital to work? In other words, is it so much a bearish call as it is a rejection of the idea that this is an opportunistic time to invest?
Tyler, you have asked a great question. So I'm going to answer this in kind of an odd way. In 1969, he pivoted from being primarily a quantitative Ben Graham value guy to being more of a Charlie Munger qualitative guy, right? Get a reasonable price on a great company. And he said back in 67, 68, 69 that the quantitative ideas that he used to like to buy were combed and recombed. That was his letter to partners. And this last year, he said that the kind of things that we would like to do have been endlessly picked over. So that is code for we think the market's expensive. We're not in any hurry. We're going to wait. And remember, he's talked constantly for 10 to 15 years that the bigger Berkshire gets, the more it limits their opportunities.
Right.
So really, to have very large opportunities for large deployments of that $200 billion, you've got to have the entire market get into very difficult circumstances.
Essentially, there are a lot of signs that Warren may be fearing a recession soon, but of course this is all just speculation based on his actions, or in this case inaction. The Berkshire cash pile has grown excessively, and it's clear based on indicators like the Buffett indicator that stocks are indeed severely overvalued. When this is the case, throughout history, the thing that has made them valuable again was an economic recession, and based on things like the 10-2 yield curve, it can be argued that we do have some worrying data that seems to suggest that we could be in trouble soon. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know what you think will happen in the markets in the comments below.